Hey everyone, so now today we're talking about Coles Group. And Coles, if you're living in Australia, is most likely a company you've heard of before. I'd be incredibly surprised if you live in Australia and you don't know what Coles is. So now, although Coles Group is primarily known for their supermarket chain being Coles, which has notoriously annoying self-checkouts, they also have a rather large variety of different retail chains. So now this includes Myers, Coles Express, and apparently something called Liquorland, which I wouldn't know what that is. I'm 17, I've never even seen it. In all seriousness, their supermarket chain in particular, and a lot of their other small businesses in between and different chains, are rather flagship. They're one of the bigger players, and all in all, Coles Group is part of a duopoly. So I think majority of people could expect to see Coles Group thriving throughout the market for some years to come. But with that being said, just because you can assume that doesn't necessarily mean you have a good understanding of whether it can or not. So I'm going to dig into some of the company's financials and fundamental analysis. That way both you and I can come up with our own ideas of whether it's worth investing in Coles Group or not. So now to start off, Coles Group is currently being traded at $16.35. Do keep in mind that this is the closing price on Friday the 14th of May. And this has more than likely changed by the time you're watching the video. Now at this price, the stock price of Coles Group is a whole 14.49% down since its 52-week high of $19.26. So now, in theory, this does mean that if the company has solid financials, including, a solid balance sheet, a solid debt-to-equity ratio, and a rather satisfactory, sustainable cash flow, we should see, hopefully, prices correct back to where they used to be, if not even higher. So now, really just hypothetically, if we saw prices return back to where they were in August 2020, which is where their 52-week high was, we would see a 17% return straight off the bat for someone that invested at the price it is at today. But that's rather hopeful thinking, because alternatively, we could see prices go down and staying down to where they used to be at their 52-week low. So now, if we were actually to see prices return back to their 52-week low back in March 2020, you could expect to see a 30% loss. Well, around there at least, if you invested at the price it is at today. And of course, as unfortunate as that would be, it's the reality of what could happen. If not, really you could see prices be much worse if essentially the company had crap financials. Now of course, sometimes we see influences outside of financials. These can both be predictable or unpredictable. This can really just range from something such as good news that the company puts out of a partnership, and that can make the stock price go up. Or we could see something as absurd as, a virus that sparks a global pandemic for over a year. But, what are the chances that would happen? Seriously though, it really is unfortunate that not everything can be predicted by a normal retail investor such as myself, or most likely you as the viewer. But one thing we can predict, and one thing you can easily look into, is company financials. I reckon almost anybody can do it to a somewhat satisfactory need, and almost anyone can attempt it. Apparently even 17-year-olds recording YouTube videos from their bedroom on a cheap web camera. So now, as of January 2021, Coles Group has seen a revenue of $39 billion a year. This is with a 2.7% profit margin, securing them earnings of $1 billion a year. So now, this is in my opinion rather huge earnings indeed, not the biggest margin. However, when a company is this large and really they are selling a large volume of goods, margins do tend to be smaller. They're still securing a huge profit. However, do keep in mind, as you can see from this chart, that they haven't really seen too much growth in earnings or revenue. Coles Group does have a return on equity of 37.6%. This is well above the industry average of 15%. So from this alone, we can already tell that the company's management team is doing very well in terms of gaining a profit using investors' money. However, on a slightly more daunting and scary note, the company's debt-to-equity ratio as of January 2021 is at 40.8%. Now this does come from their $2.7 billion equity and $1.1 billion in debt. However, this is actually covered by their operating cash flow by 286%. And along with that, their debt has reduced ever so slightly over the years. That's right, that means there is still hope for COL's, Curtis Stone and the management team. So in reality, in terms of them having quite a bit of debt, that is completely up to you whether that's a huge deal or not. Personally, I'd say being a blue chip company, and if the debts are completely covered by cash flows by quite a bit, it's not that big a deal. Their debts are going towards very, very, very safe uses, which typically they are very planned out. They've been doing this for years, and I'm very confident that they will be okay. However, you can never be too sure, which is why it's very important to make sure that their operating cash flow is properly covering that debt, and if possible, they are also reducing that debt over time. So now, speaking of debts, let's just quickly take a look at their overall financials. Where is all their money at the moment? So if we take a look at their balance sheet, you can see it's a very, very clean balance sheet indeed, with a lot of long-term assets, as you can see. Unfortunately, not so many short-term assets, which don't cover their short-term liabilities at all. Usually I'd say that's somewhat of a worry, but since COL's has such a constant sales and due to their monster of a company being so well established, I don't think they're going to fail to pay off any of their financial obligations within a year, and I'd hope that they know what they're doing. I personally think they will be okay, like I said before, with their debts. They have got plenty of cash coming in all the time, and I do think that they will be able to cover their obligations. And then finally, it's time to mention what's actually in it for you other than their potential growth, and that is their dividend. So now their dividend actually has an annual yield of 3.7% and is 100% fully franked. This is paid in September and March every year and is covered well by the company's earnings. COL's has a payout ratio of 77%, which would mean there is a likelihood of stable dividend payments. I don't personally believe we'll see any reduction in the dividend payments in any time soon. I do think COL's has this properly managed, as their payout ratio is, in my opinion, rather fair. So now it's time for me to give my final thoughts of whether this is a company that's worth investing in now. Now I do want to clear up and just say that there probably is a bit of a bias. I have actually invested in COL's Group myself. So now I do want to be fully transparent with you, and I do need to say that I did actually purchase these shares for $15.59, purchasing 64 shares in total. So now I do understand that I did purchase this at a cheaper price than it is today. However, I'd still say that the price it is at today is still worth investing in. And I truly do mean that in all honesty, that today the price is still worth investing in. Although I did buy it at a cheaper price, it's not like it's made a huge gain yet. You haven't exactly missed the boat. This will be a very slow and steady wins the race thing anyway. Don't expect to make heaps in a week. It's only made me about $28 in capital gains so far. Don't mean to brag, but comment down below, do I get the Bugatti or the Lamborghini, and what colour? I'm thinking maybe the yellow Lamborghini, but let me know. So in all seriousness, yes, I do think this is a company to buy now. But again, that's completely my opinion. As much of a surprise as I'm sure this is, I'm not actually a financial advisor. I know, huge surprise, but I'm not qualified in any way. So instead of taking this as financial advice, please do just take this as the opinion of a 17-year-old sitting in his bedroom. Because that's exactly what it is. I'm really just delivering my thoughts and hopefully sparking a few ideas in your head for you to research into yourself and to maybe decide yourself whether you want to invest or not. If I've by any chance made a mistake or I've left something out that's really important, don't hesitate to let me know. I seriously won't take any offense to it. It, if anything, really does help me out, because in future I'll know what I've forgotten to talk about in any future videos, which make sure you subscribe for if you want to see. So thank you all for watching, and I'll see you all in the next video. Thank you very much.